Marty, thank you again for the opportunity for participating in this fantastic event. And my name is Howard Cohen. I'll give a little overview of myself afterwards. I'll let Mark and Ellen introduce themselves to all of you. And chivalry still stands some places. So Ellen, you start.
Hi, I'm Ellen Baker. I'm Ellen Baker, and I'm one of the founding partners of Baker Aurora. And we consult to family offices and introduce them to alternative investments. Having said that, I like to find little nuggets. Could be emerging manager, could be emerging technology, something that you can't normally find on the internet easily. And that's what I like to bring to my family offices that I work with.
Hi, I'm Mark Jennings, Managing Director, Head of Capital Junction for Byte Investments. We are a global premium alternative platform. It's a Cayman United asset manager. And we basically created this company because we're looking to aggregate smaller investors, smaller family offices to give them access to something different that normally they wouldn't have access to if they were going through the traditional means of investing in alternatives.
Yeah, and as I said, my name is Howard Cohen. I'm an advisor with Strategies for Wealth, and I primarily work with business owners on their exit strategy and their business continuity planning. We work on tax efficiency for those that are planning for multi-generational and dynasty planning. And right now, it was mentioned earlier about taxes, and we're working very closely with our clients on the Tax Cuts and Job Acts sunsetting at the end of 2025, and it could be a very big upheaval in the way that estate taxes are have to be paid, and what you can how you can avoid the taxes. So managers, emerging managers. How would each of you define what an emerging manager is?
Ellen, ladies first.
Talked about this last night, and everybody defines an emerging manager a bit differently. We talked about there are the first-time managers. Are they really emerging managers, or is it somebody who has sort of broken out and shown that they're newer and they're a little bit different, and all of a sudden they're getting a following, so we would consider those more emerging managers. And in certain instances, maybe they have companies in their portfolio, be it venture capital or whatever, that seem to be emerging technologies. We were talking about that in the previous panel about all the AI and so forth. And that seems to be very exciting in these days and rewarding in most instances. And prior to that, everybody was looking at the secondary market and, the pre-IPOs as emerging managers.
Yeah, and so as we discussed last night, Byte was actually incubated out of a placement firm that originally was only servicing institutional investors, institutional managers. So this is third, fourth funds raising $300 or $400 million, where we would take on a minimum of $100 million raise with a traditional retainer or success fee model. And what we noticed as we opened offices around the world was there's a lot of high net worth credit investors, smaller family offices trying to access these opportunities, but they're too small. These are people with $5, $10, $25, $50 million that want to write a $500,000 $1 million check, and they were priced out of these opportunities. And we didn't really believe in that model. Why shouldn't they have access to the same thing the institutional investors have access to? So instead of, dumping $7 million, creating the next Park Hill, we incubated Byte. And we originally built it for ourselves, for our own clients, for our own opportunities, and went out to them and said, hey, here are the 100 different funds or companies, secondaries or pre-IPOs, whatever, that we have access to. Which one do you want the most? And so, by aggregating these small investors together, they get to yield a bigger stick, where they get to get institutional fees or lower minimums or better share classes because they're aggregated together. And then we, kind of cloned and now SaaSed out the technology for the funds themselves to raise money for their own funds, for their own clients, for their own investors, and show them how to aggregate these retail investors together, because it's kind of the Wild West. Only, about 2% of high net worth credit investors actually have alts in their portfolio. if you include real estate, sovereign wealth funds have 50% of their allocation alternatives, endowments, pensions, 30%. So, this is an asset class that now more and more retail investors are trying to get access to. And it's also educating the market. Educating 70% of advisors don't understand the alternative market. So if you can use this tool to obviously weed out the people it's not appropriate, educate them, and then make it easier, faster, more efficient, whether it's the compliance or the regulatory framework. Technology is obviously the future, whether it's AI or a SaaS technology like ours.
Did you have a question?
No.
Oh. So getting back to and continuing on the alternative investments. So what areas do you see and have you found for your clients? And you always Ellen speaking about your nuggets, looking for little nuggets out there. What type of nuggets have you found to be most successful over the past 3 to 5 years?
3 to 5 years is a long time, really, when you're talking about little nuggets, because they come into your sphere and then they sort of, within the year, they're gone. But prior to this panel, I was interested in the pre-IPO secondary market. But right now, I think I mentioned to you, to Mark last night, I had some fellows come to me about a month ago that had been at NASA for many years. They've been very successful with because of their relationships with DARPA and intelligence in the US. And they were explaining to me that this year alone, there's going to be $10.5 trillion cost projected because of cybercrime. And what they have done is they came up with a solution that it is called their ability to deliver a one-time pad, symmetric keys over the internet. That's something that was thought impossible, but they figured out a way to do it. It's been patented. And to me, this was very interesting because you think about the banks, you think of the casinos, you think of the airlines and all these companies that have been suffering. And, a lot of other people that have been suffering because of cybercrime. And can we eliminate passwords? Absolutely. This is something that appealed to me. It's not a manager per se, but it is emerging technology that I think is going to be a game changer. So this is something that I took under my wing and have been doing the due diligence on it. And it's something that I think is an amazing nugget because it is a game changer.
Yeah, I'd agree with that. This isn't just for funds, whether it's the direct investments or secondaries or co-investments or SPACs or SPVs or crypto or cannabis these days. So what we noticed was the topic of this conversation is emerging managers, and we were trying to determine what is an emerging manager. What we've noticed originally was anything under $100 million, nobody wants to touch because it's too small. But there's not enough fees. It doesn't make sense. Institutional investors can't touch it. I just came from a meeting where 250 is supposedly the number now, and even 500 is getting floated around that, institutional investors can't write less than 5, 10, 25, $50 million checks, and they can't be more than 5, 10% of your fund. So by using this technology and giving access to these alternatives, these nuggets per se, we just raised the largest European medtech fund in Switzerland. We raised 100 through the placement business, but several of it came from retail, high net worth, credit investors, smaller family offices that we helped aggregate together. And it's not just on the fund size, whether it's a Klarna or a SpaceX or electric battery chip company that we just helped raise money for. It's using this technology to, the world's a much smaller place, especially after a post-COVID world where people aren't flying around the world and going to Super Return and all the other conferences. They want this at their fingertips and they want to access it now. And they want to use technology to kind of weed out the ones that are not appropriate and educate them and make it easy and fast and efficient for them to invest in the opportunities that they're interested in that make appropriate for themselves.
So I was actually going to ask for a quick poll of the audience. Is anybody here not been hacked or anybody here not had some cyber issues? Yeah, there you go.
No way.
Yeah. So getting back to something, Mark, that you mentioned a little bit ago, which is the big C word, compliance, and the role of managers in compliance and the vetting of companies. And what do you see the role of the manager dealing with the compliance of the different businesses and opportunities that families could invest in?
Yeah, and just to be clear, I'm not a compliance expert. None of my advice is investment advice. But the point is that, nowadays with new rules and regulations, everything has to be one SOC 2 compliant place, right? Where your investors can come, your fund administrators, your accountants, your lawyers, all the service providers, whether you're a GP or an LP. So by utilizing technology, you can utilize it to be compliant in different jurisdictions and fulfill those requirements, whether it's putting the disclosures in the front or the back or the middle, having pre-screening process where you only weed out the people that's not appropriate and you educate them on the opportunity, but make them sign, say, a reverse solicitation to market in Europe or a virtual NDA before getting into the data room and collecting the information, say, answering 10 questions and filling out the 85-page subdoc that you have to sign that really there's only 8 or 10 spots that you have to sign or fill out. You don't want to do it manually. You want the technology to figure out what you have to fill out for you. So I think compliance is obviously a very big part of what we do. We're not a compliance firm. We're driving the end investor to the fund or GP site for them to fulfill the requirements on their website, on their platform, for their clients, for their investors. And, we're just a technology company, right? We're like Verizon, where your cable, your internet, your phone, but we're the bundle package, right? Whether we're your CRM, your data room, your onboarding platform, but our end goal is just to drive the client to the actual fund or company to invest on their site through their regulatory requirements, not our own, because we're not a compliant firm. We're just a technology company.
Marty?
Some questions from the audience. I have some questions from the audience.
Okay.
Hang
want a
on.
microphone?
What are the current hurdle rates you're seeing from emerging managers? No, you can just repeat the question.
The current hurdle rate for emerging manners. Well, I think I talked about the AUM hurdle rate is, they have to get to 100 to 250 to 500 million before institutional investors can even consider them. But did you want to add something?
No, for me, I deal with family offices, and I guess the hurdle rate for people that are in the emerging manager world, you have to find accredited investors. And there's a lot that goes into that. If it's a 506B or C, and then you have to have their accountant share with you that they're worthy of it, and it's sort of a pain in the neck. Whereas if somebody wanted to invest in stock, bond, a mutual fund, pretty easy.
Yeah, and some of these platforms are only allowing qualified investors to invest, right? So it's great to come to the table with an 80% solution, but what about your high net worths, your accredited but not qualified? A lot of these RAs or broker dealers are aggregating those investors together and writing one check as one LP into these funds or companies. But you have a rule where you only have 100 investors. So if you get to 25 million, you can aggregate the qualified and high net worths together and consider one institutional investor in your fund or company.
Almost like a feeder fund.
Yes, exactly.
And then
Or an SPV.
what kind of carried interest are you seeing? Is it most of the funds you see 2 and 20 or less?
I've recently been seeing more in the 10% carry, 15% carry, because, the demand, they can whittle down the fees. There's not a 2 and 20 environment anymore that, especially when you aggregate these small investors together, they can negotiate better fees because they're a larger size check. So they can, whittle it down to a 10% carry versus a 20.
Just as a point of interest, I learned that carried interest came from years ago when people only could transport by ship. They paid to have it transported, but when it was sold, you got a percentage of what was sold, hence carried interest.
That's very interesting. Thank you.
Jeopardy question.
Hedge fund Jeopardy.
Hedge fund Jeopardy. Mark, when we had our discussion yesterday, we were talking about RIAs and the role of RIAs in this entire world. Can you elaborate on that a little? And Ellen, you're welcome to as well.
Sure. Ellen, do you want to go first?
My area of expertise.
Well, as a former, international advisor for an RA or a hybrid RA broker dealer or a wirehouse, and living abroad, RAs are, a lot of teams are going independent. They're leaving the wirehouses, because they want to increase the performance or lower their fees or, provide something more specialized for their clients that they might not feel they can do at a large wirehouse. But when you go independent, you kind of lose that opportunity to have access to some of the big alternatives that are normally put on these platforms. And so when you go independent, you have to rely on different platforms or technologies to access these opportunities because you're no longer, at a huge wirehouse. You're now an independent RA at an independent broker dealer and so by aggregating these RAs together, we're seeing a lot of GPs show up and they say, hey, I got 3 RAs on the line. They each have $15 million. We want your technology. We want your trust company's custody so they can charge the wrap fee, or if they're a broker dealer, the transactional fee. We want your firm, that you're partnered with to set up the feeder fund or SPV, as Marty mentioned. So, it's coming to the table with the full solution, but, you add up enough of these RIAs and, their checks are as big as some of the institutional endowments or pensions. So, and they want to offer something different to their client. I know an ex-colleague of mine who's an investor and client of ours, he said the number one thing the 3 billionaires that he consults for is show me something different. Show me something that not every other, advisor on the street is offering. And by using technology and going independent, sometimes you can offer things that you wouldn't traditionally be able to offer at some of the larger shops.
People that I know that prefer the RIA or switch from being a broker dealer to an RIA feel that there's less compliance, period, end of discussion. And I know that I'm licensed and it's just nonstop regs that I have to comply with and continuing ed and so on and so forth. And I guess that's good because I'm learning all the time, all the little nuances of what people have done in the past to, hurt their clients. But so it's just a whole different ball of wax. But to your point, Mark, there also have been interest in doing RIA roll-ups. And to your point, that's so that there can be the economies of scale.
A lot of these RIAs are getting rolled up, but I think it's important to point out, an RIA, whether there's less compliance or not, it's more because it's fee-based business, right? So their revenue is tied in line with the clients. They're taking a fiduciary responsibility where, they're only going to make more money if the client's portfolio increases in value because they're normally charging a 1% wrap fee. Whereas transactional business, the fees have been scaled down because, they're no longer allowed to charge 7% up front. I think they have to charge 3.5% up front and 3.5% over 3 or 4 years or whatever it is. But being registered as a broker dealer, you can't participate in transactional business. You can't take commissions, but I think that a lot of the, big teams are going to RAs to charge flat rate fees because the clients know that their advisors are putting their best interest at heart versus just trying to make a trade or make a transactional commission.
And to that point, the SEC announced last week that they're going to be regulating RIAs the same way that they are broker dealers because of exactly what you said about compliance and things that have been lost and also revenue for the SEC. Yes.
Well, you also notice that venture capital firms are becoming RAs, or endowments or pensions are becoming RAs, which is kind of interesting when you think about it. So, it's the broadest way to be able to comply and, be able to charge fees on different products. But yes, I'm aware of the new regulations. Sorry, go ahead. Question.
Going back to the fee carry, the fact that these aggregated family offices can actually push down and negotiate all the way down to 10. Do you function in the same capacity as an anchor investor? Because, they'll probably be the basement, right?
Yeah.
10 is scary.
If you aggregate enough small enough investors, you could be an anchor investor, right? Depends on the size of the raise or the investment. If it's wrapping 100 people with 100,000 as a $10 million check. I'm not sure if you're going to be an anchor investor, but you never know. I don't know if you want to.
Have you ever, positioned yourself as an anchor?
I think we've positioned ourselves more probably on the placement side when you're representing institutional investors. But I think that with the technology and with, we have 3,500 high net worth small family offices just part of our ecosystem alone. We have 100 broker dealers, 50 distribution agreements in place. And then we have our own fund of fund. We have our own 300 million FA. So we can actually step in as an allocator and give opportunity to these RIAs or high net worth credit investors, smaller family offices to invest alongside of us. So almost like a co-investment alongside of an institutional investor, whereas it could be an anchor if it's a large enough check.
Yeah, Marty.
You had talked earlier about fee compression. Do you think that that's gonna, and you said more consolidation in the space, do you think that's gonna be the trend? And do you think that newer investor pools will be formed out of things like, wealth management groups and things like that? Or what are your thoughts?
Thank you. Yeah, look, I think you've seen fee compression across the board, whether it's, institutional or retail. I spent 10 years on the institutional side and worked at various firms like Blackstone and GSO and Highbridge. And you see how much they're consolidating their fees. Everyone's looking for fresh capital. The institutional investors, you have one bad quarter and they'll drop you, right? The retail investors tend to be stickier. Normally they can charge higher fees, right? You walk into XYZ private equity company and you have less than $1 million to drop. They're charging 3.5, 2 and 20, right? But by coming in with an aggregate of 10 other people, 100 grand in writing $1 million check, you're getting in for 1 and 17.5. So even with your 1.5, 50 basis points on your feeder, you're still giving a lower fee, lower minimum, better share class. And so I do think that, as these RIAs or broker dealers or high net worths or even smaller family offices learn to aggregate their checks together, they can yield a bigger stick and they can whittle down the fees. And I think the GPs will lower because they want the money, right? This is the Wild West. This is new, fresh capital, pools of capital for them. And it's not just, there's people investing, we have one trust company partner with, they have 46 billion, 7 RAs, they have 60,000 alternative funds on their platform. Right now, they send an Excel spreadsheet to all those RAs to showcase the alternatives on their platform. So by able to showcasing the top 50, 100 and aggregating that money together, they can help consolidate the fees.
A few years ago, ESG was the trend, and ESG seems to have become a bit of a dirty word, a dirty acronym. And just wondering, in the role of managers, what have you encountered from the people that you're working with, the funds you're working with?
The people that I've been working with lately are not, ESG is not high on their priority. It's interesting, and there's certain groups, that's all they want to do is because that's their mandate, and that's where they go. Historically, there have not been the top returns. So unless it's your mandate and your mission to do ESG and to abide by it, I haven't really found that people are overly active, to me, looking for new funds that in that area.
I think ESG, there was kind of a lot of greenwashing out there. It's like everyone's, what ESG rating is, it impact, is it imprint, is it this, is that? I think, yeah, it comes from a good place and everybody wants to invest in, environmentally sound or governed companies. But at the same time, if you're sacrificing returns over your environmental, social impact, if that's important to you, then great, and if that's more important to you than returns, then fine. But at the same time, you can't say, I'm investing in this, just because it's ESG. If your mandate is to have XYZ returns, it's an important component of it. And maybe it'll help you determine whether one investment or the other, if they have the same returns. But on the other hand, I think people are putting their pocketbooks ahead of their conscience these days.
And do you feel that there's, or have you seen that there is a reversal with any of the families or investors that ESG was part of their mandate and they're reversing?
I think the reverse is a strong word. It's still part of their mandate, but I think that their returns is their sometimes first and foremost mandate. So, I think also consolidating these ESG rating, we have a company that's invested in us. They're one of the top ESG rating companies in the world. And I think it's important to have one consolidated rating agency for ESG, not all these different, which one do you trust? People will make you ESG just to get you invest in the investment, even though it's not really ESG. But I think investment returns are always the first and foremost of people's concern.
And I think that people have found that solar and wind and all that we thought, okay, let's go, this is going to better the environment. It's very expensive in the long run. And people didn't look at the back end of how expensive all that really is.
And finding the natural resources to do this is a bone of contention of people who are really environmentalists.
So
Marty.
you guys had mentioned emerging managers earlier as needing like $100 million to really be classified. I don't know, maybe there's something called a micro emerging manager. I don't know. But so does that, my experience has been that somebody who can be an emerging manager and start with 100 million typically is a lift out from either a very successful hedge fund or like Goldman Sachs, right? So are we really classifying the emerging managers as that class of people?
No, we kind of talked about that last night because, emerging managers can be defined so many different ways. You could be a first time fund manager, you could have that you've done only SPVs, or you have a strategy or a self-managed account, or as you say, a spin out from a larger manager. So, even 100 million, I don't know if that would even, I think emerging manager is maybe their second, third fund that's emerging out of a strategy that they were managing somewhere else, or, a third or fourth fund that's emerging out of, an SMA or something that they've been doing independently that now is emerging in its own right. But I don't know if you'd add anything.
No, I think, emerging can mean a lot of different things. And I think what we thought, or we believe that things that you can find normally through your usual broker dealer that are prevalent everywhere, we would not consider that emerging. It's not the first time manager. It is possibly the one who comes back to the market and is doing extraordinarily well, be it because they've had picked the right companies that seem to be doing very well. That we would, or technologies. That was what we were calling emerging.
And are there any sectors that you're looking at right now that seem to be special? I guess that the prior panel talked about space in the venture capitalist, area, things like that. Anything that you're seeing, continuation funds, anything that you're seeing?
Of course, AI has been a hot topic. And, but as I mentioned earlier, I'm very interested right now in cybersecurity because I'm concerned about the $10.5 trillion that they anticipate will be lost in just 2025. So that's one that is of interest to me, and I've found is interest to many of my wealthy clients that are interested in investing in something that has some impact to them and to businesses that they know, and they believe that this will have incredible impact on banks, airlines, casinos, you name it, healthcare.
Yep. Well, just to answer that question, as I mentioned, my ending at the placement agent, we raised a large European MedTech fund. AI, we did help or try to help an AI fund that, didn't want to be more than 115, 125 million because they thought they'd be too big and then they'd have to write too big of checks and be in for every deal. But now they timed it right because they raised the fund a year or two ago. I'm sure they're coming back to the market for maybe a fund that's twice or three times the size. But you had a question in the audience, sir.
Yeah, are you seeing any emerging cybersecurity AI? Because obviously AI is being used in an adverse setting. And so now we're seeing a lot of amalgamation of different types of techniques for hackers to get access. And so it's no longer just a single method that can be easily stopped. So on the AI side, we need more support to actually prevent that same kind of thing. Where are you seeing that starting?
There's like an armada of negative tools
yet, and we don't have an armada of defense on the AI side yet.
Well, that's coming with quantum computing, right? So quantum computing breaks all codes. And at that point, there has to be some systems that are in place.
Right.
What those are the emerging, seems like the emerging market that's kind of, you're trying to catch the wave of, which is, you know.
AI has
companies-
happened so fast in my book. And as you, there has to be a catch up to, you know, the government is now trying to figure out how to put laws into existence to help protect people, their voice being compromised and their reputations and so forth. It's coming. I don't know of all the answers yet.
Yeah, I think I've seen it more on the SPVs or the direct investing in companies that are using AI for security. I think, you know, that's going to be an emerging trend in the new year of funds that are investing in AI security firms that are going to defend against the culprits that are using AI to hack your phone or whatever it is. So I do think that's something we'll see maybe later this year. But, you know, we'll see.
Mark, when we were speaking yesterday, we touched briefly on retail and distribution. And is this an area, first of all, so much has changed since the pandemic. And is this an area where you see an opportunity for investments?
Yeah, look, retail and distribution, I think the you know, if you looked at, you know, like what they did with the betterments or the, you know, they did it on the financial services side. I think alternatives now, you know, it's always been such a mundane process to invest. You know, someone sent an 85-page subdoc, I'll harp on again, and someone was making a $6 million investment, and the investor called back, said, if I have to fill out this 85-page subdoc, I want my money back because I'm not going to spend an hour doing that. So I do think that, you know, the technology to make it easier and faster, more efficient for retail investors to distribute opportunities, whether it's, you know, alternatives or, you know, they've already kind of done it on the stocks and bonds, ETFs. When you think about it, you can go on a travel booking site and book any airline anywhere in the world, any price, and you know, you even have sites that'll compare all these sites that do it for you, right? So I think, you know, this side of the market is starting to you know, wake up and realize that, you know, I had one GP, they were turning away 15 million of multi-family office checks, sub $1 million, because they didn't have the back office and infrastructure to facilitate that. And they said, look, if your technology can help do that, I have another 50, 100 behind it that, you know, we can send your way, because, you know, they're not going to turn away $100 million check, but they don't have, you know, sometimes your bottom 20% of your investors are your biggest pain in the rear end, and they're your friends and family and smallest investors. So a lot of people are coming to us saying, hey, I'm a third, fourth fund. I got 80 people invested $25, $50, $100,000 in my company or my fund, that they're my biggest pain in the rear end. I spend 80% of my time on them. And I want to do the right thing by them because they believed in me when I first started, but now I'm not an emerging manager. I'm an institutional manager, and I want to wrap them up and represent one K1, one quarterly update, one NAV, not 80 of them.
Ellen, anything for that?
No, I second what Mark said.
Thank you, Al.
The scale is much better, and I can only deal with an extraordinarily wealthy individual. I can only deal with the larger investor.
Sure.
It almost sounds like you're like creating Telegram groups for investing, right? I mean, you're consolidating a bunch of wealthy clients in one set or another to invest in something.
Yeah, but you know, you're also doing it for the family office groups, right? There's these family office groups that the smaller ones that are, you know, it's almost like what the consultants do for the smaller institutional investors, right? You know, if you're a school that doesn't have your own investment committee, you know, CIO, you outsource that to a consultant to advise, like a Mercer or something like that, right? So on this hand, you're using the technology, you know, what the model was everyone was driving their clients to a third-party site where you see 100 other funds just like yours and paying 25, 35 basis points for your client to invest in your fund. And now you're sending them to a third-party site where they see 100 of your competitors. So what we're seeing is people are white labeling that. They only want to offer the funds that they offer to their clients, and they want to curate that. They want to weed out the ones that are not appropriate and only, they have 5 of their own, they have 5 of ours, they 5 that they want us to go out there and give the access to their advisors to educate them, to then educate
So
their
you're
clients.
the white label solution?
Yes, exactly.
Good idea.
Thank you.
And where do you see the biggest competition for what you're doing?
There's a lot of groups that are doing 1 or 2 things. There's a lot of platforms, just like there's 1,000 placement agents out there and every one of them thinks they're better than the other one.
There's not enough.
There's not enough. There can never be enough.
We're close.
But at the same time, there's 1,000 platforms out there, right? Throw your fund or company on my platform. I guarantee I'm going to raise you X, Y, Z. We're not a distribution platform. We're an end-to-end white label tech solution. So we're just white labeling our tech that we built for ourselves, for our own clients, for our own deals, to our clients that are willing to pay us a flat rate technology fee to create it on their website, on their platform for their clients.
What's the fee structure?
It's a flat rate. Depends on if it's an SPV or a fund. It could cost you, $1,000, $2,000 a month to license it per opportunity. But at the same time, the GPs are willing to pay that just to be on a platform in front of 90 advisors with $90 billion. Because how much do they have to raise to offset $1,000, $2,000 a month, right? They raise $1 million, $2 million from that one RA. It paid for itself for the year.
No, yeah, no, absolutely. I mean, that makes all kinds of sense.
Question?
Yeah, I am. Did you have a question? No, that's a question. So yeah, I mean, we have about 5 more minutes, so.
Okay, well, I'll sing a song. Is there anything that you want to,
Are there any areas that you're staying away from in the emerging manager space, like office, real estate? Are you, anything that you're looking into, like private credit? What is hot, what's not hot, and when institutions talk to you, what do they say they're looking for? Or do they see that capability to find their own funds?
I don't necessarily go with what's hot or not hot, or I don't deal particularly with institutions, but my main thing is to look at the founders, look at the key people. To me, that's what I want to be sure that I know thick and thin about. I want to know every detail as much as I can, do due diligence on the people that are going to run the company. And of course, I have to like the idea and believe in it. I like to kick the tires. I like to believe in the product. I would invest it myself if I had the liquidity. I would put my family in it if I could. I get all passionate about the ones that I select to work with.
Yeah, I agree. I think with hot or not hot, that was like a dating app back in the 80s or 90s. But, I think that, we're generalists, right? So whether people are not investing in commercial real estate or retail real estate, or whether people are more interested in AI these days, cannabis has been kind of a disaster lately. Crypto's been all the rage, but, you got to weed out all the bad actors and, only invest in the ones that you can trust. So, our technology is not here to, we're here to kind of like, people get 100 decks a day. 95 of them are people that are trying to waste their time, sell them something they don't want, they don't need, doesn't meet the requirements. So our goal is to kind of weed out those people and only put the 5 opportunities in front of the investor or client, whether they're institutional or retail, that meet the criteria of what they're looking to invest in. And this way, time is the most valuable asset you have, right? So, that's the whole point of this, is to save time. And then the data is the other most exact, if you could see what people are clicking on, what are they looking at, what are they sharing, then what is hot and not hot.
anyone else?
To that point, I mean, I've already said this a couple of times. You find that there's a problem that's, in the economy or whatever, and you have somebody come to you with a solution, one that you believe in, one that you've, researched. That's what I would think would be hot. Something that I go, oh, I get it. I've never been particularly passionate about crypto. I can't see it. I can't feel it. I don't really understand it. I'm sort of a Buffett that way. I like to feel like, okay, brilliant idea. I have to research this. I like the people. I believe in them. I think they're honest. I believe they're honest. And that's the kind of company I really want to work with.
I think 90% of it's just telling a story, right? At the end of the day, if the story doesn't make sense, people like to invest in something they know, they understand, they understand the problem, understand the solution, understand why your solution is better than someone else's. So I do think it's important, but using technology, you have a BDR for M&A deals, where you just don't need a list of files. You need a video from the manager explaining the strategy. You need a deck that's, broken out on a site and broken down in, the team, the returns, all the information that someone would need to make, whether you're a retail or institutional investor. So I think the easier you make it, the more efficient, the more likely is they're going to invest in your fund or company.
Does your technology have analytics in it as well? Like risk assessment and things like that, or?
No, we haven't gotten that far. We do plug into, say, the Adipars, Orions, or Black Diamonds, through the trust company, so to speak. So if the RA wants to analyze the client's risk portfolio as a whole, you can include the alternative investments that they're invested in along with their portfolios at the wires or other broker dealers. We just signed a deal with Deal Cloud. So, all the clients that use Deal Cloud can use them as the CRM and us as the investment portal, right? Or some of the fund administrators like our technology better than their own. So, they're trying to sell fund administration. They don't really care which investment portal you use as long as they win the client as a fund administrator client. So, we built it all Microsoft Azure in the cloud. So if you have a CRM and you like it, we can plug into it. If you have a data room, you like it, we can plug into it. If you're working with some of the other marketing platforms out there that, who are we to tell you who to raise money from or how to, but I think we got a little residual feedback there.
I think we're good.
Now, I guess next is going to be the coolest guy in the room. And that's not you, Marty, it's Marco.
He's got his hat on, so, he must be cool.
I'm aware of that.
Thank him for the feedback.
Great job, guys.
Thank you. Appreciate it.